Hello to everyone. My name is Jorgen Lian, and I am the head of shipping equity research at DNB Markets. I would like to welcome you to Capital Link's Shipping Sector's webinar series. In this series, we have the opportunity to delve into the latest trends, challenges, and opportunities shaping the shipping sector. Today's webinar will specifically be on the LPG shipping market. Joining us in today's webinar, we have Randi Navdal Bekkelund, CFO of Avance Gas. We have Kristian Sorensen, CEO of BWLPG. We have Ted Young, CFO of Dorian LPG. And we have Mats Zacho, CEO of Navigator Holdings. The opening slide contains information as to where each company is listed and the ticker symbols. The webinar will consist of a roundtable discussion and will last for 1 hour, roughly 45 minutes for the panel discussion, followed by a 15-minute Q&A session. Participants can submit their questions using the Q&A button on your screen during the webinar, and we will do our best to answer them during the Q&A session. Please note that Capital Link will be conducting 3 polls during the webinar that will come in the start of the Q&A session. That will strictly be used for informational and educational purposes. We would appreciate your participation in answering these poll questions. Before we begin our call, please note that this discussion is strictly for informational and educational purposes and should not be relied upon. The webinar does not constitute an offer to buy or sell securities or investment advice or advice of any kind, and Capital Link bears no responsibility for the content. In terms of further disclosure, Capital Link is the investor relations advisor to some of the companies participating in this webinar. Also, DNB Markets and I cover several of the listed shipping companies included in today's webinar. So that was that. So let's begin with our discussions. And to start things off, I mean, LPG this year has really been a fantastic shipping sector. It was the same last year, to be honest. So it's been 2 years running. The current VLGC spot rates are record high in the historical context. And just to start things off, because we look at these time charter equivalent rates that we look at on the index, and I would just want to ask you, is it as simple as looking at that number and that is the number that you will generate in terms of revenues, or do we have to consider some other things that get lost in translation here? And I don't know if maybe Randi would like to start that one.
Yeah, sure. Thank you. And thank you for having me. Good to see you all, Theodore, Kristian, and Mats. Yeah, so comparing our results with the index, it has become a bit more complex than it has been in the past. It's basically looking at the AG market, Rastanura index. You should somewhat reflect the earnings in the books for AG loadings. When that's said, very few cargoes are going to Japan, representing the Rastanura. More volumes are going to India from AG, maybe some also to China. But looking at the US BWLPG.3 index, it's not becoming relevant anymore. And this is much caused by the Panama Canal bottlenecks we're currently seeing, which is caused by the worst drought since the canal opened in 1914. So in general, the Panama Canal has been an increasing inefficiency factor of the VLGC market since the Panama Canal authorities introduced the new regulations back in 1st of Jan 2020. And after that date, the VLGCs are down prioritized to transit the canal, whereas the LNG container and passenger ships are preferred. And on top of those regulations, we have the drought canal situation in the Panama. So given the massive amount of water needed to refill the canal for each transit, the canal authorities have been forced to limit the number of transit this summer. So in that sense, it's the worst we have seen in terms of waiting time ever. And looking at the BWLPG.3 index market quoting both in terms of dollar per ton and TCE per day, it doesn't take into account the waiting time or the rerouting in the Panama. So I would say it's the index rates are not representing the actual earnings for the VLGC players, much driven by the rerouting, which stretches the fleet, which is also good for the freight market, but it creates somewhat a headache for the ship owners.
Yeah, and thank you, Randi. And another thing I think is just which has surprised me on the analyst side has been the major impact of this IFRS effects on the reporting, which I guess has also been a factor.
Yeah.
Yeah. Okay, so we touched a bit on it, the Panama Canal. I think for the listeners and viewers of this webinar, let's just try and nail down the implications of this and how far along we've actually come. Ted, a question for you. How much will this impact and how much is it impacting the current situation in the LPG market?
Look, clearly, I would say it's impossible to quantify. It's a common question we get from the investment community. And as usual with LPG, there are so many things that are going on at any given time. So the Panama Canal is one factor, right? But as Randi pointed out, VLGCs have been at the bottom of the pecking order since 2020. We dealt with drought conditions in 2019, if memory serves. And, so it's sort of a recurring theme, but at the same time, we've got very favorable ARB, east-west, LPG naphtha, not so much, but still strong pull-through demand from China in particular on the petchem side. So what effect is if I try to isolate the effect of Panama? Pretty hard, but clearly it's creating length in the fleet. I think the interesting thing, and picking up a little bit on what Randi said, she's of course agreed wholeheartedly with everything with respect to the rates in the BLPG3. I think the interesting thing is we're seeing so much more in the way of Suez Canal transiting, and as much as everybody wants to use the BLPG3, our chartering guys, and I'm sure my colleagues' chartering guys are finding that they get requests all the time for Houston Chiba via Suez, which is a different, not a quoted rate historically. Obviously, the guys can, run the math. It's just math. It's about 47 days one way, but there's a rebate on the Suez Canal transit, I think, on the laden passage. So that, and also, sometimes you don't know necessarily if someone's, what someone's plans are, if they're ballasting towards the Middle East. Are they going to load Middle East, or are they going to carry on to the US? So I think it creates some further opacity in what's already kind of an opaque market. So I would say on balance, it's clearly providing more floor for rates. What happens when we unplug, I don't know, but we've seen these rates before. I mean, it's not completely unprecedented. You go back to 2015, we've seen these rates. We saw these rates in 22. So, and again, without the effect of the Panama Canal. So there are a lot of different factors at play. So trying to isolate just the Panama Canal is certainly beyond my crystal ball skills, but maybe someone else has a better answer.
Yeah, maybe direct quickly to you, Kristian. I mean, what looks very interesting to me is that the actual transits, they continue to be tapering into February. So I guess, what I'm trying to nail down is, how much is still ahead of us. Fair enough, the markets are tight at the moment, but will this just improve?
Yeah, I think, just to kind of echo Randi and Ted's comments here, the Panama Canal situation is not improving, rather to the contrary. So, and we can also see even LNG carriers are diverting to, through Suez and West Africa to a larger extent. So this is going to continue. And of course, combining the restrictions in the Panama Canal with the increased volumes from the US, it's a pretty powerful cocktail, which we are kind of seeing at the moment.
And what about for you and your business, Mats? So the same view, I imagine, bullish?
No, I mean it's pretty much the same in because we don't right now take our ships through the Panama Canal because of the restrictions and the pecking order. So that means that what used to be a 75-day round trip to Asia is now more than 100 days. So that takes capacity out of our segment, and it means that there'll be, you could say, more strain on an already tight supply-demand balance. It has been tightening for a while. There's no order book, pretty much. There's a very small order book in the handy segment and also amongst the smaller vessels. So with that healthy demand, where US production growth just keeps adding to demand, it looks robust, I must say. And Panama is of course helping here, taking capacity out of our market.
Yeah. Okay, and then let's move a bit into the fundamentals here on supply and demand. And you touched a bit on it. I think one of the most interesting indicators to follow in this sector is naturally the availability of LPG in the US for exports. One of the things that decide that is, of course, the US production outlook. And you can say the rig and drilling activity hasn't necessarily been too strong, considering where the oil price has been for some time now. How should investors follow this and what's actually going on? Because it does seem like the volumes are actually pretty good. Randi, do you have any take on that?
Yeah, I think we need to look a bit back to compare where we are today. The US LPG production has been very strong the past years. From 2020, the LPG production has increased from 87 million tons to 110 million expected this year, which corresponds to an increase of 28% just during 3 years. So this is much supported by the terminal expansions we've seen, the higher gas-oil ratio, and that combined with a relatively muted domestic consumption in the US. The propane stock levels are at historical highs, currently at 100 million barrels, and continue to drive the arbitrage levels up and leading to increased export shares, basically. So looking a bit ahead the next years, the EIA forecasts the production is expected to increase slightly, not much, about 2 to 3% next year, and relatively flat into 25. But as long as the oil price remains at decent levels, LPG production will continue to increase. The US is projecting about a total production of 114 million tons into next year, and expansion projects are on the way in some US terminals in Houston, Texas, with the Netherlands expected to add approximately 50%. Targa is also engaged in expansion projects. So yeah, we assume that the response is increased export volumes.
Yeah, you mentioned the EIA's growth forecast a bit low in our opinion. I think what's strange with LPG is it's essentially something that you produce that you don't want. So there's probably not been put too much effort into always figuring out what's going on, I think. But since you mentioned the EIA, I like to see that BW in the last earnings call, they had their own formed forecast, which I believe was a bit more optimistic, or what's the take, Kristian?
No, but I think also to run this point, the what we have historically underestimated is the how gaseous these wells are when they mature, and I think that's been very hard to predict, at least from a distance. And if you also when you see how the oil majors and also the terminals are now investing in infrastructure, in local shale oil and gas drillers and exploration companies, we see that as a very bullish sign for continued growth in the production and exports of LPG, because I don't think the export terminals, for instance, would double their capex plans and investment plans if they didn't see something in the horizon which was supporting this investment. So, but I think in hindsight, as an industry, I think we have many of us have underestimated the fact that the wells are becoming more gaseous, especially the oil wells, and that has kind of driven a lot of the the additional exports that we have seen over the last year and a half.
Yeah. And Ted, I don't know if you have anything to add, but I was going to turn the discussion a bit into the US demand side, which for this year has been surprising to the downside and essentially leaving more for exports. What's going on over there?
Well, just to pick up quickly before I answer that,
Yeah.
you know, I think we look at, so we don't do our own forecasting. We don't have that. We don't have that skill set the way I guess our peers do. But we, you know, looking at some of the private providers, you know, that we follow, I think it's a more robust outlook. You know, mid-single digits, I'd say, for the next couple of years for propane and butane. You know, globally, and a lot of that will be coming from the U.S. And I, you know, an interesting fact that often gets overlooked by a lot of the investment community, and Randi and Kristian correctly highlighted it, is the much more gassy nature of what we see going on in the U.S. So to put it in context, 1 million barrels per day in the U.S. yields 3 to 3.5 million barrels per day of LPG, whereas the same amount of oil in the Middle East yields about 1 to 1.5 million barrels per day of LPG. So, you know, it's not a barrel for a barrel, and like we touched on, increased productivity, making rig counts perhaps a bit deceptive to look at. And I agree absolutely with what Kristian said about the investment that we're seeing in out of the U.S. midstream guys, who have some of the best businesses in the world, because they really only invest when they've got guaranteed offtake or a significant portion of it. And so, you know, I think that sort of underscores the fact that the U.S. continues to be, you know, frankly, in structural decline for propane demand. You know, the ResCom share in the U.S. continues to decrease. LNG continues to penetrate, you know, vast majorities of the country. All new housing developments are really going to have LNG, not LPG, not you know, maybe heating oil, but for heating. But again, LPG is in a bit of structural decline. The only place we're seeing a bit of increase in demand is really in the petchem sector, because obviously the same reason that U.S. priced LPG is attractive to the export market, it's attractive to the domestic market. But again, it's not. The counterweight isn't enough to offset the continued lack of demand in the U.S. as the production continues to increase. So, you know, I don't think it's a change from the past. It's historically what we've seen. The U.S. has been kind of flat to down generally in consumption. You know, a bit of volatility based on what's going on in the petchem world. Although, look, more of that demand is coming from the ethane side, and it's Mads' word more than mine. But obviously, we're really long ethane in the U.S., and that's not lost on our petchem producers here domestically.
Yeah, it's I guess for the viewing audience, if not familiar, ethane even more gaseous than or lighter as material, right? So more difficult to export than LPG, right? And that was what surprised me when I started looking into it as well. And one of the theories that I heard is that you have so much ethane over there that the relative pricing is very much in favor of using ethane instead of LPG, which could also be an explanation for maybe a sticky lower demand going forward. Is that something that you see, Mats?
Well, when we look at the ethane market, we see that about 50% of the natural gas liquids that are produced are indeed the C2, the ethane, and which is then made into ethylene, which we also transport a lot of. The demand side in the US is pretty predictable, because we know what crackers are running at and how they're going to expand over time. So and the production of ethane, it just keeps growing. That means the gap between what can be off-taken by the domestic demand in the US and also then what is being produced, it just keeps growing. And that leaves room. Well, today part of it is exported, and we take part in that, and some of it is just rejected. I mean, it just stays in the natural gas because it's not separated out. So you can say there's actually scope for much more seaborne exports from the US, and that gap just keeps growing. We're seeing, because of the Panama Canal issues, that many of the VLECs that are on contract, they can't make it back to honor those offtake contracts that are in place, and that means that there's plenty of space for smaller vessels like ours, the Handysize. So what happens right now is that probably around half of the export and the transport we do out of Houston is actually ethane, and it used to be dominated by ethylene. So we see very, very robust demand for transportation of both ethane and ethylene, and we just see that the growth is going to continue, and that means that the outlook is very robust, particularly given that they're not coming any more vessels really in to transport it.
And you're also on the infrastructure side with the export terminal. So I guess you're the go-to guy when I want to ask, is there enough capacity to see this volume being shipped out to the US, or?
Yeah, and we think there is not, and that's why we are expanding the capacity. Right now, we can export a million tons per year, and we're expanding it by end next year to at least 1.6 million, but up to 3.2, because we have a flex feature where the terminal can switch between ethane and ethylene. So no, there's not enough capacity. So we're expanding it in Morgan's Point, Houston, but also at the same time our partner Enterprise, they are expanding their export capacity for ethane. So there's clearly an issue here. US could export much more ethylene and ethane if the export capacity, the logistics was in place.
And what about on the LPG side, so propane, butane exports? What does capacity utilization look like on the terminal side? And I'll leave the floor open, whoever wants to answer that.
I'll jump in for starters, since
yes.
I guess I'm closest to them, but does not give me any particular insight. Look, I think if you look across all the terminals, we're probably 85-90% utilized. I think there are some pinch points. As you look more at, as you look closer, right? And so, some of the Enterprise facilities are getting full up, and they're quite popular. One of the, I forget, I guess Galena Park's okay. I'm blanking on, there's one other one that's a little bit tight, but again, they're all pretty close, in the Gulf Coast. So, there is some ability to move it around. But again, I think I think overall, we're not particularly worried about there being enough capacity in the near term. And given the investments that the midstream guys here in the US are making, I think we all feel relatively, at least at Dorian, feel relatively confident it's not going to end up choking off trade really at all. And we don't really see it as being much of a near-term issue. But clearly, it's something that we all have to monitor. So, I think it's limited to a handful of terminals. But again, they know it. The trade knows it, and you're continuing to see record levels of exports out of the U.S. So, to me, that sort of underscores the fact that there continues to be sufficient capacity to meet all this demand.
Yeah, go ahead, Kristian.
Yeah, we also support that view, because we also see that, again, the Enterprise terminal, you also have energy transfer are expanding their capacity in 25, 26. So there is more capacity also being brought online here, which is kind of matching the expected increase in export volumes, which we see. Yeah.
I agree, but that was really my point. Since the terminals are now starting to invest and take up their capex, I believe that would indicate that the terminal's capacity is full. And right now, I guess, as we touched on earlier on, we've been helped a lot along the way to manage quite a lot of deliveries, right, by some of the disruptive events around the Panama Canal in a period that maybe might have seen the export capacity in the US hit some sort of a ceiling in the near term. Is that a right statement, or would you agree?
I would not. I don't attribute the absorption to the Panama Canal.
Okay.
If I have to attribute it to anything, and I'm probably in the minority, at least in my own company, on this view, if you look pretty simplistically at the increase in exports from the Middle East, which had been flat at 35 million metric tons after Mr. Putin invaded and attacked Ukraine, magically, or not so magically, 7 million metric tons transitioned to the Middle East. that's actually 1 million more metric tons than the Russians were actually exporting, none of which in our business's case was going on VLGCs. They went on some of Mads's ship out of Ust-Luga, about half that volume, at least from what we could tell, and the other half going on rail cars to Central Europe and to the republics in the Caucasus, Kazakhstan and Georgia and the like. But so 7 million metric tons corresponds roughly to 28 VLGCs versus 42, let's say, deliveries that are probably going to happen this year, 46 originally expected. To me, that absolves a lot of sin, i.e. absorbed a lot of capacity. The Panama Canal helped. I don't know what would have happened had had those 7 million metric tons not shifted. Again, but we can still continue to see good pull-through demand. Obviously, China waking from its COVID slumber helped, catch up slack capacity, but I don't attribute it personally to the Panama Canal effect. But others may disagree.
I like your input, Ted. I actually agree. I think because my point has been, for some time that you haven't really seen the major effect of this Panama disruption yet. I would think so. That's the point. I think we still have a lot of fun times ahead of us, and especially when you look at the curve. I mean, it's starting to reflect that, right? Which is amazing.
Yeah, I mean, look, I think all of us are reluctant to look too far ahead, but I think to your point, and Kristian was probably the most adventurous among us in his comments, but I tend to agree with him. I mean, look, and Randy's right. They're cutting transits further. I don't know what the rain forecast is. All three of us have reported our bookings through, whatever the date we reported them on. They were all really robust, and rates have generally improved even since then. So I think the tightness is not expected to abate anytime soon. Obviously, it will. And look, there's obviously, look, at some point you've got to be mindful of the fact that, it's wonderful how much money we're making, and as you've pointed out many times, Jorgen, we capture as an industry a lot of the arb. But the other players in the value chain have to make money. So we don't want to see this go on, in my opinion, too long before people start getting crazy ideas like, I don't know, pipelines underground, or Lord knows, or pipelines across Panama, which have been
or a pipeline, Panama pipeline. That's the one we're all scared of.
Things get bad, hogs get slaughtered. So
exactly. So, but you mentioned Middle East, I think, because that's a good point. I actually, when we did our latest update as well, it was one of the things that surprised to the upside. Don't know if you want to take a stab on that, Randi, but those volumes, they look incredibly strong, even in a historical context, and despite what's been going on in terms of the OPEC production cuts and everything else. What's going on, and is it sustainable? I mean, is there any downside risk? Has there been built up any storage that is now being drawn on, or what's going on?
Well, the regional LPG output is expected to remain relatively tight, even though it's been surprisingly high. Looking at the kind of the dark side of the VLGC trade, actually quite a big chunk of the VLGC global fleet are going from Iran to China. We had a slide on that in our presentation as well. It might be that some of the volumes are going into that captive trade, but as I said, we expect that the LPG output from the Middle East is expected to be tight until the end of this year as a result of the OPEC cuts. And the VLGCs and the LPG market are heading into a peak winter season in the Northeast Asia, or we're actually in that season now, which should support freight rates in the near term. So I think also the demand is expected to rise further into the Chinese PDH plants are due to resume more operations, even though they have experienced somewhat lower operating margins during this quarter. They need to keep up the cash flow to handle that portion.
Yes. It's a bit contrary maybe to, because now as we move into sort of demand for LPG imports, I mean, it's a bit contrary maybe to the macroeconomic backdrop that we've seen, that there should be that much demand in the petchem industry to produce plastics and chemicals in a time when everything seems to slow a bit. What should we look at in terms of drivers for that oil or underlying demand? Kristian, if you want to go, what indicators should investors follow?
Yeah, I think there are two main demand sectors in Asia, and you have typically in the developing world, it's for the residential sector, heating, cooking. That's typically the Indian subcontinent, Southeast Asia. When you move further up to Northeast Asia, is still a big residential demand, which is supporting the imports. But of course, you have the PDH plants, which especially the Chinese have expanded tremendously over the last couple of years, and we can, there is a political drive behind this. So even though the margins these PDH plants are running at the moment doesn't really seem to make sense. They also have an OPEX to cover, so they need to have a run rate to cover to pay the bill, so to say. And we can see that there is a political will to capture the petchem market from the Chinese government side. So that's probably supporting this more than it would be if it was pure economic or financial runners behind or drivers behind it.
I mean, I'd add to that from what we understand, a lot of the profit margins that people are focusing on are net profit margins. And just kind of drilling down a bit on what Kristian said, they're covering, from what we understand, they're producing a positive variable margin, so they continue to make a contribution to fixed costs. So economics 101 would tell you that they're being rational and continuing to produce. I think the other piece of the puzzle that's quite interesting is, what in excess of 90% of these PDH plants, as we understand them, are part of more integrated producers, producing, acrylonitrile and some of the other byproducts that are quite profitable. So obviously, again, microeconomics 101 would tell you should do your transfer pricing at marginal cost. So looking again at just one piece of the value chain, particularly as part of an integrated enterprise, probably is a bit deceiving, because Kristian's absolutely right that there's definitely political will there. And that drives a lot of behavior, but there actually is, from what we understand, a bit of economic logic to go with it, which is provide some additional comfort. I think we all can see the political influence and how it plays a role in decision making in certain state economies or state influenced economies, and then there's a little bit of old-fashioned microeconomics that also provides some support. So I think from both perspectives, it's not, the guys appear to be behaving fairly rationally, which again gives us some comfort about the longer term or midterm stability.
So a potential recession doesn't really impact LPG demand. Okay. Go ahead, Mats.
No, that would be a brave statement.
Yeah.
For sure. But I think, at least for some of the products that we're transporting, I mean, if you look at the ethylene export, if you look at that through COVID, it actually accelerated. So you saw a demand fall off a cliff for many products globally during COVID, but for ethylene, it just held up strongly and just kept continuing. So I don't think necessarily there is this one-to-one correlation with the global economy. I mean, it is to some extent driven by the arbitrages, and here it's back to really the structural price competitiveness of the products that are coming out of the US that make a big difference. I'd also like to highlight that what we're seeing right now is that the OPEC is managing the output of oil, whereas you could say the gas is being freely produced. It's a free market there, and that probably means that we'll continue to see that oil price, the gap between or the competitiveness of gas vis-a-vis oil will continue to be strong here. So that adds to at least my confidence in how that spread is continuing.
I'd also, I think I'd just add quickly, because I agree with that, Mats. If you look really historically, right, if you go back to 1980, the global LPG market has had only 2 down years of production and consumption. So even in the great financial crisis, I think we were roughly flat on a global LPG production and consumption. I forget, seaborne trade may have been down a tick, but not much. But again, the relative profitability in those times is obviously, it can be more challenging. I mean, our world operates, I won't say independently of any of that, but overall less demand is never good for anybody, and financially challenging times aren't good for anybody's business.
But it's been sustainable, strong demand growth in this sector for a long time, which is one of the reasons why it's interesting from a shipping perspective, right?
No, absolutely. I mean, there's base demand. 47% of world LPG goes into heating and cooking. That you can't switch that off very quickly.
And especially when gas heads to Europe all of a sudden, natural gas, then it's a driver. Another question I get a lot that I think we should answer is, you have all these impacts from Russia's invasion of Ukraine going on in the tanker space. How does that look for LPG? I mean, has that been a contributor to the tightness in the market? And do we, see a risk if that should reverse on the LPG side that's equivalent to what we've seen in some of the other shipping sectors? Randi, would you like to give a short answer?
Yeah, sure. If we look at the overall LPG export that goes to Europe, it's actually a minor share. It's about 10 to 15% of all seaborne export. So not a lot, as the main trade patterns are between US, Asia, Middle East, Asia, and the freight market is less exposed than shipping in general, I would say. When that said, we saw a spike last year. Last year there were additional demand for LPG in Europe in general because of the very high natural gas prices on the back of Russia not able to supply Europe anymore, which kind of incentivized the fuel switching by consumers away from gas to our other storage levels ahead of the peak winter heating season. So yeah, it might happen again, but at this point in time, we don't expect or see any major spikes, and that's also on the back of the capacity on the terminal side for importing LPG as energy source.
But Jorgen, you were saying if it was to reverse itself, and again, even if the war was to miraculously come to a halt soon, which we all hope and pray it will, there'll be a long time before Europe will be comfortable with Russia and with that dependency on energy for Russia. So I see that what we've seen now is not going to reverse itself in 2, 3, or 5 years' time. Maybe I can just add a comment on ammonia here. Here we saw a big disruption in the trading patterns where Europe was importing a lot of natural gas for production in Europe, but also ammonia from Russia and Ukraine. And here we had to transport it in from far away, like North America or Asia. And those trade patterns, even when ammonia prices came down in the beginning of the year, we still see a very strong demand for shipping of ammonia. So I think this disruption is there, and I think it's going to continue for a long time.
Yeah, I was just going to add on that in terms of the unwind effect. I agree with everything Randi and Mads said. And in addition, look, I think not an expert in tankers, but a big part of where the Russian product comes from, right, is through the Black Sea, and that's been heavily affected by the hostilities between Russia and Ukraine for obvious geographic reasons. That's just not a part of our world. That's not to the best of my knowledge, there are no VLGC capable ports in there. Maybe there's some MGC capable ports, but it's just not a big part of the world. And so, we're fortunate in that regard. And as I already kind of highlighted, the Russians kind of managed to, I don't know what they're doing with their product. I think some of it will go to China on rail car, but next year I expect that'll be the case, but not enough that I think it'll make a dent in the VLGC demand going into China. And as Mads said, I think it'll be a long time before the rest of the world feels comfortable purchasing Russian hydrocarbons, no matter how cheap they get. I mean, sure, they'll purchase them, but not in the same volumes and not to the same level of dependency.
And
but Jorgen, I think it's fair to say that we indirectly have been impacted because the war has increase the production of hydrocarbons in the US, which is pretty much supporting the export we talked about earlier today. So it's I think indirectly the VLGC market has probably been affected by the Ukraine war.
Yeah, I would agree, and especially the gas flows that have changed and probably incentivized some more LPG imports. And then one of the explanations, maybe why the market has been surprisingly strong this year. I remember going into this year, there was a lot of skepticism to the order book with a lot of vessels being delivered. Some of those vessels have been delayed, and one could argue, there's still some deliveries ahead of us. Are we out of the woods on this, Kristian, or how does the supply side look?
Well, like you say, we are more or less through the big order book this year. We have another, let's say, 15, 16 ships or so to be delivered next year, I guess, and then another 50 in the year after. So there are ships coming, but if you, it seems like the new ships are being phased in quite nicely, and I think that's reflected quite well also in the rate level that we're seeing. And of course, here there are, the main drivers are, as we talked about already, the Panama Canal congestion and the increased volumes from the US, and then also the Middle East volumes, we talked about. And if you look a little bit forward, after 25, 26, there's another 8-9 million tons we estimate coming from Qatar on the back of the LNG trains there. So there should be good reasons to believe that this is sustainable.
Yeah. And what about the old vessels? We're seeing these regulations in shipping step in. Are you seeing vessels being phased out, or are they still hanging in? And what's the outlook for that?
If you look at the vintage vessels built typically 2006 to 2010, we've had I guess 40 of them sold to regional trade or storage operations in Southeast Asia and Caribbean and so on, taken out of the market. So that's also another factor which it's not like these ships are sold to another owner who's trading them in the market. They disappear from the market when they're sold. And that's also been a factor which I think we have underestimated over the last year or so, that you actually have had 35 to 40 ships which have disappeared from the day-to-day spot market and taken
Are those the Black Fleet vessels that you mentioned, Randi, or and
partly,
is there any potential for getting them back? Or
Yeah, there are some of these kind of dark vessels, which we estimate to be around 50 vessels, representing 13% of the VLGC fleet today, are going to storage capacity and captive trade between Iran, China, where we don't participate. And they are not participating in our spot market, basically. So they're taken out of the spot freight market where we're participating. So I fully agree with Kristian here. Just a few comments to add. So looking at the global fleet today, about 40% is actually older than 10 years, which means that the majority of these vessels will need to have engine power limitations on board to meet the EEXI regulations. When speaking about regulations, which was introduced the 1st of Jan this year, and the ship owners need to have this in place during year end, probably early Jan 24. So this is basically a technical exercise which can easily be installed by sailing. It's not a major modification. However, it also means that the vessel who are required to have this EPL installed on board to meet the regulations, the max speed will be reduced, depending on the spec of the vessel, of course, but the max speed will be estimated to be reduced by 1 to 2 knots. So I have actually checked the speed of these vessels in the data flow which we have access to, and I see that the vessels in older than 10 years have actually gone, the speed on these vessels have actually gone slightly up this year by 1.1 knots, as the market has been super strong. So we haven't seen the reduction in speed in terms of increasing the ton mileage, etc. yet, but I strongly believe that it will have a greater impact into 24 when the CII rating is available to everyone, where we will rank the vessels with an ATE rating, and for any vessels obtaining D to E, or D rating for the 3 consecutive years and an E rating for 1 year, need to have a correction plan and take the vessel out of trade, basically. So yeah,
you've had an exceptional market at the moment, right? So I think at least if anything, it's at least the safety valve should things sort of normalize at some point. I think there's a lot of potential. Go ahead, Mats.
Maybe, Jorgen, I can just mention that the dynamics are a little bit different in the handy segment, the smaller vessels, because here the order book is almost non-existent. I mean, 4% of the fleet on water is right now in the order book to be delivered over the next 2-3 years, and the lead times in the yards are probably around 3 years if you want to build a new one. So that means that our visibility on the supply is pretty good, actually. Adding to that is also that 20% of the global handy fleet is over 20 years old. So so there really is an issue around supply that will lead to a strength or a tightening of the demand supply balance here. We tend to, even despite the regulation and so on, we tend to trade our ships until 25 years, and then they're sold also here for regional trades and disappear out of our trading.
But I actually agree that, or I would say that on the VLGCs after the coming quarter, I think the order book starts to look pretty thin as well. So I think actually across the sector, it seems rather attractive on the supply side, given where we are in the markets at the moment, which is a total U-turn from where we were a year ago, right? And makes it incredibly interesting. So finally, we'll soon jump to the Q&A, but just wanted to. There's been some writing in the press, Ted, about a new build order. Can I ask, does that look interesting at the moment? Given where prices are, I mean, it indicates stellar expectations at the current price level to build a new build. What would you say? New building or secondhand value or divest?
Well, look, I think it's, look, they're very firm prices for the older vessels, as Kristian pointed out. We sold a few, Avance and BW have also sold a few into that market. It's been a pretty firm area, and obviously for all the reasons Randi outlined, it makes sense. Straight new builds, straight VLGCs, probably a bit challenging at the current levels without making some very potentially heroic rate assumptions to get to an appropriate IRR. Once you add it, if you're looking at ammonia, which obviously is expected to be quite a growth trade, given the complexity, the relative scarcity, and what generally seems to be high charterer interest, it feels like you're probably more likely to be able to find rates that would justify the investment at those levels. Only time will tell, but based on the environmental pressures and in spite of what you read in the press, it's still a drop in the bucket in terms of the players in the market who've invested in the ammonia space. So time will tell to see what people do, including us, in that sector. But there is ample reason to be optimistic about the future demand and indeed the rates that one could get. I mean, as technically demanding as shipping LPG is, and Mods can speak to this far better, and ammonia kind of takes it in many ways to a new level. The safety concerns for crew are multiples, I would say, because ammonia is so toxic. And I think it bears mentioning that we all think about the safety of our seafarers, everyone on this call. The investment community may not appreciate that as much. So that's a real concern and making sure that there's all the right safety protocols in place. And that would typically be associated with, ultimately a higher charter rate, because just like I think charterers really care who ships their hydrocarbons, charterers are going to really care that they're not on the front page of a major newspaper for a toxic ammonia release like happened in China or Taiwan in 21 that unfortunately killed 2 dock workers. So it's a specialized product that requires special equipment and special handling, and that usually leads to more supportable day rates.
Okay, I think we'll now do that polling that we talked about and head a bit into Q&A. And I have some more questions as well, but you should see the poll pop up for you now. So please answer those questions, and we'll get the results shortly. And while that goes on, I'll look at some of the questions that have come in. One of them has been the Fed's rate increase seems to be approaching an end. How does that play into the LPG case, both on drilling activity, increasing production, port facility updates, and such? Anyone feel?
Yeah, maybe I can just add a comment here. I don't think any of us in our business case models had ever used an interest rate close to 0. I think we've always, when we did our business cases, added somewhat a normalized cost of debt into it, because we knew that it was only for a short period of time we would see these low interest rates. So I don't think that in itself really affects the way we are thinking about investments, because we never thought we could finance a ship for 25 years at nothing plus 200 basis points. But of course, I mean, it does impact the drilling activity and so on. It also impacts our profit and loss statements that some of us have had now higher interest rate cost and so on. So there's an impact that in that direction. But I don't think as such in our ordering activity.
Yeah, I think in terms of, I think I'd add to that again, 47% of world demand, 50% of world demand come from residential commercial. Sure, at the margin, if you're, financially strapped, you might not refill that canister as frequently, but you're still going to be buying LPG for your heating and cooking needs. And on the petchem side, obviously, historically, that's been an interest rate sensitive sector, but kind of what we all look at in our sector is what's already been committed, and so when we're all aware of projects and putting them into our own calculations, those aren't really speculative, those are committed. So folks made those commitments absent or in light of the current interest rate environment or the now prevailing interest rate environment. So from that perspective, I think some of it's already baked in, but look, all else equal, lower interest rates, we saw what that does. It's the equivalent of amphetamines for the economy. So, but again, in our sectors, probably less of an impact. I'd agree with Mats.
Yeah. Now we can end the poll and see if we have any good answers. So there were a lot of bullish people on the call, heading into the call, and as much as 60% said they were bullish to the LPG sector headed into the call. Albeit not very bullish, that was only 10%. But now, after the discussion that we've had, 50% are equally bullish and 50% are more bullish. I think we did our job. And of the greatest sort of focal points informing that view, close to 50% talking about the shipping-specific disruptions. I would assume that relates a lot to the Panama Canal, but evenly spread actually, quite across the other answers as well, which is interesting to see. I have another question here. You're earning tons of cash. Will you think about adding even more dividends, or what are you going to do with all that cash? If anyone, I believe you pay out most of the cash already, many of you, but go ahead, Kristian, if you want.
Yeah, I mean, we are, our policy is pretty transparent, you know. So we, as long as our net leverage is below or 20% or lower, we have the ambition to pay out the earnings, you know, on the shipping side. So we think that's the best way in this market to return value to our shareholders.
What about you, Ted? You have this discretionary dividend. How do you think about that going forward?
It's irregular. It's irregular, not totally discretionary. It's irregular.
Okay, irregular. But it's regular to. It's pretty regular to being an irregular dividend, though.
I wouldn't. That's those are your words, not mine. You know, we look. I mean, you know, we've been pretty clear that we're not comfortable being tied to a formula. You know, we look at our cash forecast, for which we have pretty good visibility for 3 months, and maybe a bit more, and we make some decisions in consultation with our board. And you know, obviously, we've been avid returners of capital in this rate environment, and you know, but it's still, we have to allow the flexibility to have a buffer, have a reserve for the inevitable bumps in the road, future investment, and all those sorts of things. So I think, you know, you'll continue to see us do what we've been doing and really focus on total shareholder return.
Yeah. Thank you. And then I think worth highlighting here, you know, we've been talking about this sector for a long time. It's been sort of the deep value discounted sector in shipping. Now it's not. So how to capitalize on that valuation? We talked a bit about the new building prices being high, etc. How are you going to use the investors' valuation of your company to generate growth? Is there what's the way to go forward? I'll leave the floor to whoever jumps on the mic first.
I could add here that we're still the odd people out. We're still trading at a sizable discount to our net asset value, and you also haven't seen our net asset or our asset values go up to the same extent. They've gone up a little bit. So we are still lagging somewhat behind here, and that means that share buybacks and it's still a way to go forward. I mean, we introduced a capital return policy this year that is a part share buyback and part dividends. So we will continue to do that. But at the same time, we also still see a lot of attractive opportunities out there to grow our business, both on the infrastructure side, as we're doing with Enterprise right now and expanding the Morgan's Point terminal. But also we see some scope for consolidation here, where since asset prices have not really moved that much up, we still see some attractive transactions that could be done.
And you probably want to say something, Kristian, on
so we,
expanding into the value chain.
Yeah, so we have today announced a transaction on the infrastructure terminal side, which is we have communicated this to the market for a while, that we have been looking at various opportunities to continue to invest further into the value chain after the expansion of product services last year. So and we believe, especially in today's new building price environment, secondhand price environment, that it's hard to justify the shipping to grow. I mean, it's hard to find out how to grow profitably in shipping. So we believe it's a good time for us to look at other ways of growing the business, like we have announced today. And we have kind of decided to develop that business model because we believe it's gonna bring us into more or make us more robust over the cycles.
So Mats and Kristian expanding a bit into the value chain. Randi, you expanded from the VLGC side into MGCs, which are a smaller type of vessel. What's the thinking behind that?
Yeah, for Avance Gas, it's been all about investing and divesting at the right time of the cycle. So taking you back in time a few years ago, we contracted 6 VLGCs at an average price of 80 million. Today, you need to pay about 120 million plus for deliveries in 27. So that was a good investment a couple of years back. And we basically saw the same opportunity on the MGC side. The order book has been relatively muted, and we also see the potential on ammonia demand down the line. So yeah, we basically acquired them due to attractive pricing. We acquired them at 61.5, and today they're quoted about 70 million per vessel. So yeah, in terms of speaking about net asset values, etc., we, as you said, Jorgen, with 8 years, with a 30 to 50% discount on the share, we're finally there. So it should be a very perfect timing of raising equity if you're a listed company in our segment. But on the other hand, for us, it makes sense to raise equity when you have a project attached. And with the current new building prices and the second-hand prices for VLGCs, we're focused on divesting the older part. Yeah, it's just not the right timing for Avance to contract more than we have the past years. So our focus ahead is maintaining, returning shareholder value back by paying dividends, basically.
And I know we were running a bit out of time, but I got a very good question from Mats, so I thought I'd end with that one, because I found it very interesting on looking at the order book. Actually, there's been a considerable amount of these VLECs, so the large ethane carriers that have been ordered, and it's a fair point. So a question to you, considering all of this fleet expansion on the VLEC segment versus the demand growth on the long haul ethane trades, how does the future look like for the smaller vessel trades in that the vessel segment going forward?
Well, you can certainly say that right now we are seeing that there's not enough VLECs to fulfill the offtake agreements. So right now that means a lot of additional business for us. I mean, when the Panama Canal issue sorts itself out, if it ever does, and once more VLECs are being delivered, that will mean that there'll be less cross-Pacific, cross-Atlantic ethane transportation on our ships, and that's fine because our business case is really not built up on being a large transporter across the major oceans on ethane. It's kind of an icing on the cake right now. The core scenario for us is really the ethylene export with the expansion of the terminal happening, meaning that there'll be a lot of additional ethylene transport for us. So I think we are fine. We are looking with great interest at the expansion, and we think that ethane will be very competitive for a long period of time out of North America.
Okay. I think the time has run out, and I would say thank you to everyone listening in and joining. There were quite a few questions. I didn't get around to answering them all, I'm afraid. But and also thank you to the panelists for taking their time to answer and explain what's going on.
Thank you.
Thank you.
So, and then I have a closing remark. Thank you, everyone, for taking the time to join us today. Please note that this webinar will soon be made available for access upon demand on Capital Link's website at www.capitallinkwebinars.com and on Capital Link's YouTube channel. So tune in if there's anything you want to hear once more. And with that, I say thank you to everyone for joining, and thank you to our panelists.
Have a fantastic day all. Thank you.
Bye.
Bye.